Wall Street's having a Black Friday sale this year as well, but it looks like it's going to be on energy stocks. This is where the money is. Happy Thursday, everybody. I'm Tyler, here with Taylor. Of course, when it's Thursday, we talk energy and materials, and it's a pretty good time to be talking about it because
pretty exciting.
Over Thanksgiving, we had the big OPEC announcement that they were going to maintain oil production about 30 million barrels per day.
That's right, yep.
Excuse me. So we've seen the price of oil absolutely plummet. We're looking at Brent crude right around $75 range.
I think a little less, actually.
Even less than 70. Ooh. And then West Texas Intermediate doing its same thing. And just about everybody in the energy sector, deservedly or undeservedly, has been hammered.
Yeah, you look at it across the board. I didn't really see the news on Thursday. I came out of the woods in Big Bend National Park on Friday to see a lot of my portfolio in the red, unfortunately, because covering energy, invest in what you know. A lot of names, like you mentioned, undeservedly so. One sector I realized that I don't think really deserved the hit that they took on Friday was some of the rails up in Canada that carry a lot of this crude. I don't own any in particular, but I might in a couple weeks if they maintain this low level. Canadian National Railway and Canadian Pacific in particular. Crude by rail has been a big storyline over the last 2 years, but it hasn't really been a big driver of revenue for these companies. They do have higher hopes in the future for it, but in 2013, Canadian National Rail only derived 4% of its revenue from crude transports. We were talking earlier, ag, coal, heavy machinery. These are the things that are really driving carloads on the railways. I think only 70,000 carloads for CNR over the 2013 calendar year versus 5 million total. So really not a big driver here. Canadian Pacific, I think, is relying on a little bit more for future growth. I read an article today saying that they're looking maybe a third of their revenue growth out to 2018 would come from crude shipments, either on the terminal side or by actually carrying the oil. So maybe further down the line they might be hit, but I don't view this as a 3-year slump in oil prices. So I think it's going to be coming back likely before this time next year at the very latest in my mind, because OPEC did say that they're only going to test this 30 million barrels per day level for 6 months and then reconvene and see what they think.
Yeah, it'll be interesting to see what happens with this. And, this is one of the things, as a long-term investor, I think this is one of those opportunities where you can see an event that creates mass hysteria in the market. I mean, we saw some independent oil producers drop by as much as 35, 40%
Oh my God,
the past
you look
couple
at
days.
US Silica, Carbo Ceramics, and High Crush Partners, their whole revenue stream is tied to fracking. And that's one of the first places to go when you see lower oil prices, supposedly. And so they like 25, 30% for these companies in a single day.
Yeah, and it did just happen on Thanksgiving, so a lot of us are like, gave us a whole day to think about it and exactly how it's going to work out, and obviously the market didn't like it. But I think as a long-term investor, this is really one of those opportunities where you can get involved in some really great companies that are now today selling at a discount. Some of the things that have really been on my radar as of late have been the big oil companies, for example. A lot of people are going to say, oh, they're going to get hit by these lower oil prices. Yes, of course, everybody's going to get hit by them.
Everybody has, yeah.
But if you look at somebody like Big Oil, ExxonMobil, how long have they been around? They've been around for 100 years. They've gone through these up and down cycles hundreds and hundreds of times. They've maintained their dividend. They've grown their dividend. They maintain a rock-solid balance sheet, and they have the ability to kind of hedge that oil price dip, when you have your natural gas production on top of the entire vertical integration that you have within the company, refining, retail, everything. So it helps to kind of spread the pain around a little bit. So, and if you look at where these companies have gone, they're only down like 10% on the year, but at the same time that does present that one buying opportunity for somebody that maybe have been looking at one of these companies and is like, this is just one of those really good times. And for me personally, I think actually one that isn't necessarily in the big oil space, but again, one of those rock solid companies that is trading in a massive discount is National Oil Well Varco. Same thing, rock solid balance sheet, is in one of those positions within the market where, it's going to get hurt by a lack of drilling activity, a little bit of oversupply of the rig market. But with their market dominant position and that aftermarket sales that they have, where anything that's a consumable or replaceable, such as drill bits, they have to go through National Oilwell Varco. It's
OEM.
It's really hard to really bet against them right now, especially with a company that's trading at 10 times earnings. It really looks like a good pickup.
Yeah, and when you look at this, I think it's going to be an interesting test for the relatively new CEO. Pete Miller took a step back. Now he's the chairman of D-Now, the distribution business. So he kind of maybe got in a little bit of a rockier time than maybe he thought, because National Oilwell Varco has done so well for so long. So it'll be interesting to see how he tries to keep the ship stable. But that's one of the strongest companies in the business. A little bit more niche focused than an Exxon, but you're playing offshore oil with them, and that's the next generation of oil production as land just starts to dry up a little bit. And then we turn to an Ask a Fool question. A lot of people want to know about what's going on in energy and dividend payers, and are they going to be able to keep those dividends, or can they grow them? So we had a question about Canadian National Resources and Suncor from a student up in Canada. He wanted to know, which do we believe in over the long term, and which do you think can withstand this downturn the best and maybe maintain or increase that dividend? What's your thought?
Well, I am not the expert in Canada, as you may be. I don't spend as much time focusing on that, but what I have seen in studying Suncor Energy, it's one of Warren Buffett's largest stocks, and I've been looking at it for a long time. One of the things that makes them so attractive right now is, despite the fact that they are one of those companies that's going to get hammered by oil prices, probably even more so than a lot of other people, because of the Canadian, I guess you could, constricted market, where most of it is going to be shipping down into the United States. But at the same time, their per unit costs are extremely low in the oil sands business in comparison to a lot of other people right now. And at the same time, they are able to do their upgrading in-house with a lot of their upgrading facilities, as well as their own refineries. So they're not a completely integrated oil and gas company like an ExxonMobil or something like that, but they have the integration where they can sell their products at a higher premium than than somebody like a Canadian Natural Resources, which obviously helps them in the long term. And the other thing that has been great for them is their ability to generate cash from continuing operations in excess of what they're actually doing capital expenditure wise. It gives them a little bit more of a cushion when as oil prices start to drop. They'll be able to kind of weather the storm certainly a lot better than somebody like a Canadian Natural.
Yeah, and you mentioned them selling their oil at a premium. They've got the great infrastructure set up to get their oil to the coast, so they're selling at the Brent price rather than the WTI price or even the Canadian Select price, which have tended to be lower, even significantly lower in the Canadian Select price perspective in the past. So that's one of their key advantages, even over U.S. Integrated producers. And talking about their dividend, I think Suncor is in a little bit better position. They're both relatively solid in maintaining that dividend, I think, over the short term. And because you look at their balance sheet is very strong, but Suncor is a little bit stronger. Current ratio well above 1, whereas Canadian Naturals is around 0.5. So that's a little bit in the initial liquidity that I'm a little worried about. I don't like it under 0.75 for a dividend payer, but their total debt to equity isn't that bad. It's only around 50%, so I can live with that. And right now they're paying a very similar yield, 2.5% for Suncor, 2.1% for Canadian Natural. So if I wanted to look at a dividend player potentially to increase it, I would go with Suncor as well, not only from the production side, but from the balance sheet side. Even though Canadian Natural has increased its dividend 3% per year for the last 5 years, more than Suncor, about 33% compound annually. Suncor is the Canadian producer that I would want to tie myself to long term.
Plus, Suncor's been actually buying a lot of stock back in the past couple of years. Yeah. So, if that is something where they're looking, either one, they could be buying stock back at a discount right now, or they could even be using that in times of a little bit dire straits to put that back into the dividend. So in terms of dividend safety, it looks like that one's certainly a little bit safer than what's going on.
Yeah, the stock buybacks are a very positive thing for me if they're done properly. So if they're buying back on Friday or Monday, I would be a happy shareholder, because that increases my earnings per share with the limited share count out there on the market.
Definitely. So we want to thank you all for joining us today. Obviously, there's a lot of companies out there right now. Take a really good look at what's going on, because we've had a huge market overreaction, and sometimes you can really find those gems. Some of them we talked about today, but there's still a lot out there to check. We'll be looking for them, and hopefully we'll discuss them next time.
That's right.
So for Taylor, I'm Tyler, and we'll see you next time.